Hello, welcome on the second part of our webinars with Prime Academy, with Prime Quotes. Today we're going to talk in greater detail about what we mentioned on Tuesday. Basics of the market, basics of trading. Today we're going to expand this. We're going to talk about more advanced concepts. Let's start. Again, small introduction for those who are with our webinars for the first time. I do have over 10 years experience in trading, but the thing is that I trade on live real accounts, and which is pretty uncommon. Most educators, let's say, they just trade on demo. They don't have this experience, but I do run live trading seminars where I show my account history, where I show my real trades, etc. In my trading, I'm focusing on price action. I'm a swing trader. I do mostly technical analysis. So this is the way how I trade. Let's expand on the technical analysis that we mentioned on Tuesday. In general, technical analysis focuses on a trader looking at the chart or a plain chart, just a chart, so price movements over time, or together with some indicators and oscillators. And those are also based on the charts. Various equations come into play. Some of them are based on momentum. Some of them are based on the history, etc., etc. But basically, these are just variations of price movements over time. And based on this, technical trader tries to predict the future market movement. He tries to trade, and also, well, in general, technical analysis is based on a few foundations. First one is that price moves in trends. Price follows trends. So in general, price can move in three trends. Uptrend, so the price is making higher highs and high lows. Downtrend, price is making lower lows and lower highs. And sideways trend, so price basically moves, the volatility is lower and stays more or less in the same place with really small fluctuations over time. And for example, after 1 month, 2 months, the price is more or less in the same range as it was before. Another principle, another foundation of the technical analysis is that price movements tend to repeat themselves. So price over time tends to make the same patterns, the same formations, which tend to result in a similar or the same way. Of course, not always, because if that was always the case, trading, everybody would be a successful trader because you could always bet on this particular formation. But still, price repeats itself, price movements repeat themselves more than 50% of the time. So it's enough to give you an edge over the market. So these are those foundations of the technical analysis, and basically traders using technical analysis, they follow those in order to gain an edge over the market and in order to make some money. As for the key indicators, so we have, for example, MACD, RSI. When after the slides, I will move to the platform, I will show you those indicators. We also have moving averages, more or less. They are used for the traders to estimate the trend. If there is a downtrend, uptrend, or trend is changing. But really, after some time, when you will gain experience in trading, you will not need moving averages in order to tell what the trend is. You will just need one a short look on the charts, and you will be able to estimate the trend. It will not be a problem at all. But these are just three examples of indicators and oscillators, and really uh, you have hundreds of technical tools which you can use in your trading, or you don't have to even use any tools, just price movements over time. And this is pretty much what price action is all about. Charts can be drawn in three main ways. You have more ways to draw a chart, but main three ways: line chart, which is pretty common. You even Bloomberg, financial media, CNBC, etc. They draw line charts because everybody understands the line chart. You have also bar charts and candlestick charts. More or less, bar and candles give you the same prices, but candles are easier to grasp, let's say, and they also come with additional bonus. They come with candlestick formations, candlestick patterns. You either can have one candlestick formation, two candlestick formation, or four candlestick formation. And that you can use in your trading additionally. So that's an additional way edge over the market, which you don't have if you use a line chart. You can trade based on the technical analysis, but you don't have to. You can also use fundamentals. So basically, fundamentals, when we talk about the forex market, so currency trading fundamentals means assessing a currency value by examining related economic, financial, and other qualitative and quantitative factors. For example, GDP, gross domestic product, inflation, interest rate, etc. So basically, in the long term, in the long run, you try to buy the currency of better economy and sell the currency of struggling economy. If in a long-term trading, it's basically the case. Practical case is that currencies tend to move. Of course, all the instruments tend to move in line with fundamentals. But practical approach is that there is fundamental data being published. So, for example, this GDP. And before the publication, you have consensus, you have estimate, which is generally expected by economists. And once the final number comes and it's different than the estimate, you have a reaction because traders knew that something's going to happen, but it did not happen. They have different scenario, so they have to adjust their positioning to a new, different scenario. So, for example, GDP was expected at 1%, it came at 2%, so they need to reassess their view on this economy, on this particular currency. The by far the most important data right now is non-farm payrolls. It's published every first Friday of the month. Is the change of the employment in the American economy. In general, a higher number means that more people were employed, which is better for the economy. A lower number means that it's that the economy is struggling. During COVID, we had minus few millions. Now we have plus, let's say, 100,000, 200,000 jobs being created. Another thing, well, money can buy things, so things have price. But money have also price themselves, right? So money has have a price, and this price of money is interest rate. Some currencies have lower interest rate, like for example, Japanese yen. Some of the currencies have higher interest rates, like emerging markets currencies, like Turkish lira, for example, high interest rate. In general, if you buy currency with higher interest rate and you sell currency with the lower interest rate, you should be earning money overnight thanks to swaps. And this strategy of buying currency with higher interest rate is called carry trading. Very important thing. So just to sum up this fundamentals, you can either use technicals, so just basically look at the charts, look at the price movements over time, or you can also use fundamentals. So you can look at the macro data and buy currency with better macro data and buy it against the currency with worse economy. And basically, you can also combine those two. So, for example, you can use fundamentals to estimate the sentiment and maybe the direction, and use the technicals to estimate the proper timing to buy or proper place to buy or sell, like a proper support or resistance. So that's basically you can combine them together. Once you can use this, one other time you can use this. It's which path you will take is really not the most important thing, because the most important thing in trading is trading psychology and risk control and money management. So that's the key. That's the number one, and that's why we're gonna focus on this slide. Trading psychology is absolutely the key. On the previous webinar, I showed you two books from the trading psychology, which was two books by Mark Douglas, Trading in the Zone and The Disciplined Trader. And I highly recommend you to buy those books because they are all you basically need in trading, all you need when investing. And this knowledge from those books is absolutely essential for you to start making money. And if you don't believe it now, you will eventually find out it yourself. Every trader who is in this game for a long run eventually understands that trading psychology is the key. Trading psychology is the most important thing. But you just need to give yourself enough time to learn it. And you give yourself enough time by trading small, by trading with small positions, small orders. You give yourself time by risking 1, 2% of the capital per position maximum. If you risk 20% on one trade, that's a very first step to wipe out your whole account, and you don't want to do this. And because you will not give yourself time to gain experience, gain knowledge, and learn about the trading psychology and traders' mindset, which is again by far number one factor in successful trading. And by successful trading, I mean being profitable month over month, quarter over quarter, year over year, because trading is such an activity that really total beginner can open the chart, can press buy or sell button, and can make excellent money. But of course, it's a pure luck. Then he can do it 5 times in a row, maybe 10 times in a row, but and it's gonna be extreme luck. It's gonna be fantastic luck, absolutely amazing. But in order to make money quarter over quarter, month over month, and year over year, so in essence, in order to be a profitable trader, constantly profitable trader, then you really need proper trading psychology, trader's mindset. Uh, when you're gonna start trading on a real account, you will see that there is many traps waiting for you in trading. I mentioned few of them. Over trading, for example, is one of the most important ones. I sometimes, even after 10 or 12 years of trading, I sometimes suffer from over trading. That I'm just sitting in front of the charts. There is really no proper tier one A plus trading signal, but I push myself to open something because I just want to feel this um, thrill and also be a trader, right? Trader trades. But the thing is that traders really being a trader is also doing nothing. Many people would say it's amazing to do nothing, but that's doing nothing and patiently waiting for a tier one setup is really it's really essential part of trading. You will do that a lot. And by do that a lot, I mean do nothing and just wait for a proper setup. So over trading is really a struggle. That can be a struggle because it's irrational for you to do nothing because then you think that maybe you just waste your time. But no, waiting for a tier one A plus setup is part of your trading journey. Then there is fear and greed, which is also which can also be a problem and is a problem. You at the beginning you can feel fear almost with every step. But in general, if I would have to tell you why you feel fear, the two main reasons. So when you open a position and you are scared, when you feel fear, there is two reasons for this. First one is that it's not your tier one A plus setup, so you are afraid that it's not gonna work out. Okay, and you just open something randomly and you're not convinced. If you were convinced and you would open tier one A plus setup, then you would not be scared because you know that opening the setup is just part of your routine. It's part of the journey. It is a tier one setup, and you know that it will not always be a profit. You know that over time, out of 100 trades, 60 times it will be a profit and 40 times it will be a loss. So if you opened it in line with your trading system, then everything is fine. Then you don't feel fear. It's just a part of the process, right? Another more common reason why you feel scared when you trade is that the position is too big. So suddenly you see this floating profit and loss, and you start feeling uncomfortable, especially if it's on a green, it's if it's on a red side. So if it's a floating loss, then you start to feel scared about your money that you will lose too much money. And the problem is again in you because you opened too big position. The position that you open was out of the money management and risk control rules, and it's absolutely your fault. You should open really small positions which are in line with your risk control and money management, and that's also the case. If your positions are small and they are open in line with your trading strategy, then there is no place for fear. There is no place to feel scared because as a robot, you just opened your position, which you should do. And in long term, those positions may bring profits. Simple as that, my friends. On Tuesday, I was mentioning I divided trading strategies for the time. So we had day trading, swing trading, and position trading for a long time. We can also divide them for different types of strategies. For example, scalping means opening positions, small positions with a big volume, trying to catch small market movements for a few pips, several pips maximum. That's one way to do it, but it's very demanding from the psychological point of view. And also, you need to spend a lot of hours in front of the computer. Carry trading, I mentioned that. So you're benefiting from higher interest rates. You buy currency with higher interest rate. But the thing, and these are just the few, we are just scratching the surface here, of course. But what is the most important thing is that the strategy should suit you. If you don't mind spending whole day in front of the computer and you like activity, thrill, you like emotions, then scalping day trading is maybe for you. I like peace and quiet, calmness. So I don't day trade. I do swing trading. and I try to escape from those emotions in trading. And I'm not a momentum trader. I'm a price action trader. So it suits my personality and my character. We mentioned leverage. The first time leverage is thing which differentiate forex market from the other markets, because again forex market is not really volatile. It's liquid, it's not volatile, which means that usually currency changes on the currency market are, let's say, 0.2%, 0.4. That's whole daily change in the from the minimum to maximum, or from the maximum to minimum. It would be really difficult to make some decent money on such small changes using small capital like $1,000. On the stock market, stocks can move 2-3% without any news whatsoever. On the forex market, it's impossible. I mean, there were days that currency pairs moved 5% or something, but it was some kind of a disaster and some kind of absolute game changer. Usually it's less than 1%. So that's why the concept of leverage was introduced, which allows you to make money on small price movements. Because having $1,000, for example, you control $100,000, and it makes a difference, right? But the thing is, leverage, thanks to that, leverage can bring you bigger profits, but it's a double-edged sword, so it can give you also bigger losses. So really watch out for the leverage. Don't go too crazy with that. It's very important to build your own trading plan. As I said, the strategy should suit yourself, mm, and it should have everything. So not only when to open a position, but foremost, the trading strategy system should tell you when to close your position, when to close your position on on a hypothetical loss, but also on profit. So you should always have a stop loss order. The position size should be always small and not exceeding 2% of your capital. That should be absolute imperative of your trading strategy, and everything should be written, everything should be followed, etc. But it's that's not it. That's not it, because only having this written and trying to follow this is one thing, but actually following this, it's another game. It's a completely different game, and that what makes trading difficult. Trading is easy as a concept, but it's hard to follow because of this discipline that is required to follow your strategy or journal. Trading is really just a game of probability and discipline. And you need to think in probabilities, and you need to be very disciplined. Once you will have those two things, trading world is open for you. We have own Telegram group where we give signals. This week I just put signal on Tuesday, although I have some good running trades, but I didn't find them worthy of sending a signal. Although, as you will see in a second, they are really profitable at the moment, but it's sometimes like this. So yes, let me show you actually. Let me show you actually my platform. As you can see, this is my trading account, and we do have quite nice profits here, coming mostly from the strengthening of the Swiss franc, which can be currently seen on the market. As you can see here, nice drop. Look, stop loss was on $160. It's original stop loss. I didn't change anything. And now the position brings $240. So profit is bigger than the initial loss. And that's going to be a lesson from the money management straight away. When the paper profit, because it's still paper profit, is bigger than the initial loss on the stop loss order, I remove totally the risk from this position by moving stop loss to break even point. So you can see now I cannot lose on this position. It's on a break even. So when the price will reverse, I will earn $5, which will cover the commission here. Nicely, those drops are accelerating. I enjoy it. I have also British pound to Swiss franc. Here the drop is even stronger. As you can see, a drop $500, slightly more than the risk that I was telling you. But do as I say, not do as I do. Profit here is $2,000, pretty sweet profit if you ask me, and the price is in an absolute downfall, as you can see. Probably something happened, but I will have to access the news in order to tell you what, that the British pound is in a such downfall. You can see here also British pound to American dollar, we're breaking key support, and euro to British pound is climbing higher. So probably something happened on the British pound side of the transaction. Anyways, here, for example, I could also move my stop loss to break even, and I will do it here as well, because also profit was bigger than the initial loss. So in those two transactions, I totally removed the risk from those trades. So fair enough. I'm happy with those two entries. If I wanted to show you those indicators in order to have maybe let's go with this. Let's go with this template. Oh, it's going to be very interesting case because we're going to see a divergence here. First of all, the support on New Zealand dollar to Canadian dollar, in my opinion, price breaking this green line, that will be a signal to sell. Here you can see triple top formation or double top formation, if you will. And those double tops and double bottoms are confirmed by divergence of the indicators, those indicators that I was telling you before. So MACD and RSI. Let me explain. Of course, it is. I'm just guessing, but it's always like this. I will tell you. When you have a double top and double bottom, price is making high, price is making higher high. And the divergence with oscillators means that this oscillator should more or less follow the price all the time. So when the price is making higher high, the oscillator should make higher high as well. But as you can see, price is making higher high here, but histogram does not make higher high, and also RSI does not make higher high. In addition to this, here we are on the overbought area. RSI above 70 means that this instrument is overbought, and we have a drop, and we have a drop. Once the price will break the green support, we're going to have a proper signal to sell with a target on the yellow area. And that will be an amazing example of the double top formation. So you can see you don't really need a lot of trading tools. You just need a few of them. Actually, let me explain you why I opened those positions, because maybe you would be interested in that. And of course, I will share with you. This is Canadian dollar to Swiss franc drop, and there was a sideways trend. and this sideways was just a rectangle. So we had a horizontal resistance here, horizontal support here, that's a rectangle. Maybe let me just highlight the resistance. There was also a support. And you can see that support was broken today. Then it was tested as a resistance. Test was positive for the sellers because the price bounced off this resistance and is now going lower. That's very clean. There is no magic in there. That's just how it is. That's one way to do it. You can see that there is no really like extremely advanced trading concepts. Uh, just this, the price ended sideways trend and went significantly lower and continued the trend because that's one of the foundations of the technical analysis that price follows trends. Another example is here, this British pound to Swiss franc drop. Here it wasn't a rectangle, it was a flag. Flag is a rectangle, but with a little angle. And then we broke the lower line of this flag, and then the price is collapsing. It will not go straight away to this support like a downfall, like a waterfall. Most probably we're going to have some correction and then another drop. Most probably it is going to look like this. We are about to find out, of course, still. But again, you can see this is pretty simple approach, clean and simple approach. If you want more, of course, I invite you to our next webinars. We will expand our webinars offer, and we'll talk more about advanced market concepts. But still, you're just starting, so we have a lot of knowledge to grasp right now. Read those books of Mark Douglas for sure, and then you can always ask questions, send questions to Prime Quotes staff. If you have any questions to me, you can send them on Prime Academy. You can find me on Prime Academy social media, and then ask me questions there, and I will be more than happy to answer and help you in your trading journey. As for now, thanks very much for attending this webinar. I enjoyed sharing my knowledge a lot with you, and I keep my fingers crossed for your trading journey. Thanks a lot, and bye.